Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 31st of July. I'm Daniel Lam, your host for the podcast. A while back, I spoke about how the central bankers can be burdened by this persistence of memory. Of course, we've all got a tinkle in our minds whenever people uses the word transitory nowadays. Yes, I'm talking about the episode back in the fourth quarter of 2021 when the Fed spoke about inflation being transitory. And shall I say, the rest is history. Now, this episode must be in the mind of the FOMC members. Overnight, the Fed held rates steady for a fifth straight meeting, with a divided FOMC and resilient growth keeping policy on hold. So the target range remains at 4.25 to 4.5, with the statement reflecting only a modest downgrade to the growth outlook. Two governors dissented, as expected. This highlighted the policy split observed at the June meeting. So this divide is in the critical element of inflation. Now, given how the 2021 and 2022 episode is still fresh in people's minds, the Fed really cannot have another episode of a policy mistake. Its credibility is at stake. So therefore, the hawks prefer to wait, citing still resilient growth, and of course the concerns over tariff-driven inflation. The Dows want to cut rates. They talk about the slowing growth momentum and a willingness to look through near-term price pressures. Now for now, the FOMC consensus is with the hawks, as the labor market is softening, but it's not broken yet, and inflation convergence has been slow. So what about Powell? He has repeatedly used the word solid to characterize the economy and the labor market, that non-farm payroll was slowing, but so was labor supply. The unemployment rate was stable at full employment, even though the employment-to-population ratio has continued to fall. So the risk now is that the Fed would need ample evidence before making a move, and by that time, a slowdown could well be on its momentum. So risky assets reaction was mildly risk-off, with S&P 500 ending near the intraday low. US dollar strengthened with the hawkish tilt, while the Hang Seng Index night futures, which had been benefiting from a weak US dollar, was down by another 1% post Hong Kong close yesterday. So we're likely to be seeing some consolidation ahead. The S&P 500, as we pointed out earlier this week, is increasingly tired in its up move. Now, the Magnificent Seven have been reporting very reasonable earnings overall, but most of them would have reported by the end of this week. Now, we're likely to see a pullback to test the 6,280 support level, and that could be followed by a test of 6,000. The non-farm payroll this Friday night will be critical to watch. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.